So let's take a look at one of the most important assets, if not the most liquid asset on our balance sheet. That asset is known as cash. Now, cash is really important because if we do not control the cash and lose the cash, it'll be very difficult to get the cash back. So when we talk about controlling cash, we need to make sure that we've established the responsibility of who is eligible to take care of the cash. Who's responsible? In a retail establishment, the cash is controlled by the cashiers. We want to make sure that all transactions are documented with proper receipts or some other documentation that shows that cash is moving within the company. We also want to segregate the duties to make sure that the person who controls the cash is not the person who's recording the transaction. From a human resources standpoint, we want to make sure that individuals who cover cash are covered by an insurance policy. We call that insurance policy a bond. We also want to ensure that the physical cash is protected by physical controls such as cash registers and safes. Then finally, we want to make sure there's independent verification of the process as well as the actual physical cash by an independent individual who will either count the cash or provide some sort of control to make sure that the cash has been protected. So here's an example of what would happen in an over-the-counter situation with cash. A clerk who receives cash from a customer takes the cash and puts it in their cash register. The cash register also comes up with cash receipts, and eventually a cashier would have to come up and take the cash to prepare the deposit to go into the bank. The cashier would create a deposit slip to accompany the deposit, but also a duplicate deposit slip that would go to the accounting department, who would keep track of all the deposits being made by the company. When the bank recognizes that a deposit has been made, the accounting department can take the duplicate deposit slip and compare it to the transaction that's been authorized by the bank. So what happens if your customer mails payments of invoices to your company? Any mail receipt should be opened by two people. Dual custody of an asset ensures that not just one person has access and can act alone in terms of the commission of a fraud. The second person can be watching over, and in fact, both people watch over each other. When they create that list of deposits that are going to be made, the clerk signs that list to ensure that he or she is taking responsibility for that data. The original copy of the list, along with the checks, is sent to the cashier's department, who maintains that information and also creates the deposit slip. The copy of the list that went to the cashier goes to the accounting department to protect the cash. When we disperse cash, in other words, we're giving cash out, we want to make sure that we also have controls. Normally, our disbursements will either be in the form of a check or an electronic funds transfer. We do not make cash disbursements with cash because it does not provide an adequate audit trail for us to record the transaction. So normally in a cash disbursement situation, we will designate who's responsible for signing the check. The person who signs the check does not process the payment. They are merely a check signer as an approver of the disbursement. We want to segregate the duties between the approver and the person who prepares the cash disbursement or the check itself. Once again, we do want to have independent verification in that someone is checking to make sure that the person who signs the check is different than the person who prepares the check and authorizes the payment in the accounts payable system. Bonding still makes sense for our employees because they're handling the checks. Most companies use a voucher system as part of their cash disbursement system. A voucher is a series of approvals that are made prior to the creation of a check and the approval of that disbursement. A voucher is an authorization form that accompanies all the supporting documents for the preparation of a check and ultimately the signing and approval of the cash disbursement. So the question then is, why is this so important? Because normally what we've found is that in many cases fraud occurs from employees because of the fraud triangle. They have a financial need, they have been given access to the assets, and then they come up with a rationalization of why the fraud occurs. So the question then is, how do we reduce the likelihood that fraud could occur? Ideally, the separation of duties and the proper documentation of the system and the vigilance of management to ensure that the internal controls are in place to protect from fraud. One of the things that you could do is use a bank. When we control cash, the bank is a third party that helps protect the assets. We can minimize the amount of cash that we keep within the company and keep the majority of our cash within the bank. The bank independently is keeping track of cash, and they are reporting back to the company of how much cash is in their account or is available for disbursement. Once that bank statement has been provided by the bank to the company, an important control that has to be put in place is that the company on a timely basis prepares a bank reconciliation. This is what a bank statement may look like. Notice in the bank statement it identifies what the beginning cash balance is, what increases the cash, deposits and other credits, what decreases the account, checks and other debits, and ultimately what the final cash balance is. You may notice on this slide the discussion of a debit memo versus a credit memo. When we receive a debit memo or a credit memo from a bank, these two documents are telling us what they have done in your account at the bank. Remember, you as a customer depositing money in a bank create a liability for the bank. The bank is obligated to return your cash or to hold your cash until you request for return of their asset. So, if this is a liability, a credit memo would increase their liability. A debit memo would decrease the bank's liability. So when the bank charges a service charge to you, the customer, they are using your money in your account to pay off the bank's service charge. So the payment of that bank service charge reduces their liability in your account that you've put money in. So when we do a bank reconciliation, we need to keep in mind any debit and credit memos that are provided by the bank. So when we reconcile a bank account, we need to look at these four items: deposits in transit, outstanding checks, bank memos, and possibly any errors that were committed by us the customer in our accounting records or the bank has committed in their accounting records. So we can set up a bank reconciliation into two columns: a balance per the bank statement and a balance per the book statement. The balance per the book statement is the dollar amount that is in your general ledger. We can look at the two columns individually. The balance per bank is coming from the bank statement, and we increase the balance per bank by the deposits in transit, and we subtract out any outstanding checks, and we'll either increase or decrease the bank statement for any mistakes that the bank may have made. Now, to identify, a deposit in transit is a deposit made by you, the customer, that has not been recognized by the bank at the time of the printing of the bank statement. This occurs many times because of when a bank is in business versus when you make your deposit. If you make a night deposit on the last day of the period, the bank may not process your deposit until the next day or the next several days. So therefore, you have recognized the deposit, but the bank has not recognized the deposit. Similarly, if you have written a check and have sent the payment out to your vendor, but it has not been deposited by your vendor into their bank so that money is being taken out of your bank account, that check is considered an outstanding check. You knew about the disbursement, but your bank does not know what's your disbursement. So when I take the balance per bank, add in the deposits in transit, subtract out the outstanding checks, and then make the adjustment for any bank errors, I get an adjusted bank balance. Next, when I take the balance per books, I need to basically increase or decrease my balance per books to anything that the bank knew about that our company did not know about. So when a bank collects a notes receivable for us and puts the cash into our bank account, we are notified of that activity by a memorandum and the bank statement. So we need to increase our balance per books in order to reflect the increase in cash. Now, if we have received any checks from our customers and those checks have bounced, those bounced checks are called NSF, non-sufficient funds. So typically, when a bank processes a check for us as part of our deposit, if the customer check bounces, they will take the money out of your account. So we need to subtract the dollars out of the balance per books. Any additional charges that the bank has made against your account needs to be reduced out of the per book balance. So what ends up happening is, once you take the balance per books, add in the funds collected by the bank on your behalf, subtract out the NSF checks, subtract out any other service charges, and then make adjustments for any errors that you have made, you will then have an adjusted book balance. If we compare the adjusted bank balance and the adjusted book balance, these two numbers should equal. Once we've figured out that these two numbers equal, we know that we have reconciled our bank account. Once we've reconciled our bank account, then we need to make adjusting journal entries for all the adjusting items on the balance per book side. So let's give it a try. Illustration 7.7 presented the bank statement for Laird Company, which the company assessed online. It shows a balance per bank of $15,907 on April 30th. On this date, the balance per books is $11,589. From the foregoing steps, Laird determines the following reconciling items: deposits in transit, outstanding checks, errors, and bank memos. So now you have the information for the two columns. The balance per bank, $15,907. The balance per book, $11,589. You take the four steps and put them in the proper columns to determine what the bank reconciliation should look like. So this is what the reconciliation should look like. The balance per bank adjusted by the increase of the deposits in transit with the decrease of the outstanding checks gives us an adjusted cash balance of $12,204.85. If we take into account the balance per books, we have the error of $36. We have an NSF check which decreases our balance per books by $425, and we have bank service charges that decreases our balance, and then the bank collected the note receivable. Notice that the adjusted cash balance per books is the same amount as the adjusted cash balance per bank. So we have reconciled our bank account. Next, we have to do the journal entries to recognize the four reconciling items in our bank reconciliation. We have to make a journal entry that records the change in cash of cash going up by $1,035. In that, we had miscellaneous expenses of $15, a collection of the note receivable of $1,000, and interest of $50. This was all done for the collection of the note receivable. Next, on the book error, where it said the cash disbursement journal showed that the check was a payment on account to Andrea Company, a supplier, the correcting entry is to increase cash by $36 and increase accounts payable by $36. The NSF check, because the original entry was a debit to cash, a credit to accounts receivable, the adjusting entry because of the bank reconciliation is to reinstate the accounts receivable and decrease the cash. For bank service charges, we have to recognize that we have a bank charge, so we debit miscellaneous expense for $30 and decrease the cash for $30. So when we take a look at the ledger, we come up with the debit and credit entries to get an ending balance of $12,204.85. While many companies are still using checks as a means for cash disbursements, we are finding that more and more companies are allowing electronic funds transfers as part of the process of exchanging funds between parties. The use of electronic funds transfers' biggest advantage is the speed of processing. However, one of the other areas for electronic funds transfer is that cash never enters the company. The funds are electronically transmitted over to the company's bank account without ever anyone taking possession of the asset. Now we have to understand what cash is. We know that cash is currency and coin, but we can also look at cash equivalents with anything that can be quickly converted to cash, such as a short-term investment that's about to mature. A check, while it isn't currency, can be deposited and can be turned into cash. So in essence, when we report cash on the balance sheet, cash is cash as well as any cash equivalent. In some cases, companies have made commitments on their cash where they cannot use it for general purposes. In these situations, we call the cash restricted. So here's an example for Delta Airlines of how they handle their cash. Cash and cash equivalents is the most liquid asset within the company and therefore listed first on their balance sheet. Note the third item in red, restricted cash, where there is cash within the company but it's been earmarked for a specific purpose. The operating cycle of a merchandise company, where we start with cash, we purchase inventory, we then sell the inventory, which turns into accounts receivable, which eventually gets paid by the customer, is called the cash operating cycle of a merchandise company. Along with the importance of controlling the policies and procedures of cash, is the policy of managing cash. We talk about managing cash as using the cash to the best potential of the asset. So, first of all, we want to make sure that we increase the speed of receivable collection. As I mentioned before, your business is not to finance your customers. So therefore, we want to make it possible to collect the cash as soon as possible, even though we extend credit to our customers. That's the reason why we offer the discount for early payment of our invoices. Also, we don't want to maintain too much inventory, because if we purchase too much inventory, even if it's on credit, our vendors will eventually want us to pay for that inventory. So we would end up having to tie up our cash in inventory. So too much inventory would mean that we're improperly using our cash. Third, we want to monitor the payment of our liabilities. We want to pay our bills when they're due. We don't want to pay our bills too early, because then our vendors receive the benefit of our cash and we haven't properly used our cash on a timely basis. Fourth, we want to time our major expenditures. We want to make sure that we're purchasing major purchases when we have available cash, not when we need the cash for our normal day-to-day operations. If there are any additional cash, we want to make sure we're investing that cash in something that will provide us an adequate return on our investment, so that we're not losing money by just hanging on to it or placing it in the bank. So one of the things that you may want to do is you want to prepare a cash budget, understanding that where your cash starts and making the assumptions of how you're going to collect cash and use your cash, and also how you're going to use your cash. If you're in managerial accounting or cost accounting, you will spend some time on the budgeting process. But even if you don't take those two classes, one of the things that you should be able to do is the preparation of a cash budget.